welcome to this video. In this one, we're going to go through risk management and we're really going to look at how we can stay safe in the markets while we're trading, because that really has to be the core fundamental part of our plan. We don't want to gamble, we don't want to trade too big, but we also don't want to trade too small because we don't want to miss out on those trading opportunities. So in this video, you should be able to understand how we can keep our risks safe throughout our trading at all times. So this is risk management and how to structure it correctly. So what's the correct use of risk management? This is a really interesting topic because lots of traders, when they start to enter the market, they're not completely clear on it. And often they won't even have a risk management plan anyway. And that can be really problematic because it can lead to much higher losses and sustained losses over time. And we really don't want that. So risk management, it's equally as important as your overall trade taking strategy. So that's looking at charts and seeing where you're going to buy and sell or go long or short. And it really forms the core principle for trading profitably. All profitable traders will have a risk management plan because they know they need to stay safe in their trading in order to make it a long-term business. And that's what we're really looking for. And that's what you should be looking for too. It's a long-term business trading. Okay, and often you're going to be trading with leverage. So a risk management plan is going to allow you to keep safe at all times, regardless of any black swan events. So they're things that happen that are very unforeseen in the market. As of late, you will have seen it with the COVID crisis, and you would have seen it many times in the past before. And those really are times when you're going to find that losses start to build, and you're going to need to be able to manage your risk so that isn't an issue. Because if you plan for it, you're always going to be ready. It's like the saying, if you fail to prepare, then you're preparing to fail. So risk management plans, they're going to allow you to be consistently profitable over time and make much more money. Okay, so really what we're looking for is to be prepared for those times when the market might swing against you, and it might swing against you hard. And if you're trading too big, obviously that's going to be an issue because you'll just get closed out of your positions and you'll see those losses build. So this plan is going to have to be a best fit plan, and it must be based on your overall capital. So firstly, how do traders get it wrong? And often it really just goes a little bit like this. A trader will start trading, they'll enter the market, and then they'll suddenly realize, hang on, my trading size is way too big. And slowly those losses will build. And it really is because they don't have a strategy and they're just not prepared for it. And unfortunately, this is a common occurrence when traders become interested in the markets because they really don't prepare for it or they've not been taught it. So risk management is key, and you really need to have that strategy ready for all times. And sometimes newbie traders, they'll get a bit misled because they'll be taking gains and then suddenly it will all close out when things start to go against them. So they may find that they get a margin call eventually, even if they've made profit beforehand. So in short, trading too large, it just doesn't work, and it never will. And it's not feasible to do that. That is often what gamblers do when they go in a casino, and obviously we all know how that ends. So when you're trading, you really need to trade proportionally, and this is a big part of risk management. A lot of the time, and yourself, you may have heard rules such as only risk a certain percent of your account at any time or on any trade, or you should only risk a maximum of 1, maybe 2% on any trade. And that's just not ideal, because if you trade with a stop loss, for example, at 2%, over time, you're going to have that risk of closing out over and over again in a loss. And ultimately, that's going to lead you to start having a huge drawdown. So your trade size, really, it's much better if you base it on your available capital or equity, and it should be done by lot size rather than percent size of your available capital. So for every $1,000, $5,000, $10,000, you need to know exactly how big you're going to trade at any time for any position. And that's going to mean you're going to be accumulating positions as price rises or falls, rather than just having one buy or one sell with one stop, because then you only get one chance to get it right. So lots of large institutions and hedge funds, things like that, professional traders, they spread their risk and they spread their positions because it drastically reduces what they're at risk or their exposure in the market. So how can we spread risk then, and what does that really mean? So when you place one buy or one sell position and you've got your stop loss set, you're really going to need to be right that one time. And often price will go against you, and a lot of the time with newbie traders, they find they just start to build losses because the market just keeps going against them over and over again, and they just keep getting stopped out and it costs them money. So instead, you need to split your position up or take smaller positions and spread them out as price rises or price falls. And therefore you have lots and lots of shots at a target, and that's much more preferable than one. And that's something I teach my members to do because I know how well it works and I use it in my own trading. Okay, so instead of having one shot of the market with stop losses, we can accumulate positions over time. Now, stop losses, they're not awful things. You can trade with them and you can still make money, but you just need to be really careful where you put them, especially if you're accumulating positions over time and spreading your risk. So also a big part of risk management is leverage, and lots of traders, they don't understand leverage or how it works. So we're going to run through it now. To manage your risk effectively, you really need to understand how this works. Basically, in the markets, you have your leverage, and essentially it is a multiplier or an amount of funds that the broker effectively gives you to trade with, because a lot of the time people don't have the capital to do it. So if you didn't have leverage, you wouldn't be able to trade. So leverage enables regular people just to trade, and it effectively gives them more capital to do so. And some of them see it as a door to trading large, and obviously, as you will now know, that doesn't work. So because of these leverage funds, you're going to be subject to risk and you're going to need to manage your risk. So understanding that you have leverage funds and you've got higher exposure is really going to be helpful in keeping your risk management right. And you need to understand that just because you've got leverage doesn't mean you need to up your size and look at the gains and the huge wins you can have, because that's just not going to work long term. And that's called over leveraging, and it's just non-consistent. So position sizes, they're going to have to be small and they're going to have to be across several assets to enable you to spread your risk. And that's because not all assets move at the same volatility. Some will be slow, some will be fast, and some will just dwindle. So if you spread your risk, you can take more trades at a smaller size, and therefore you don't have as large of an exposure. So really, what is the goal and what should you take away from this video? So it's really important to understand that our goal in trading is to stay solvent, just like a business would, and take gains consistently via accurate trading and great risk management. And remember, as I've repeated, risk management is at the core of successful trading. You just can't have it without it. You're going to need to be able to manage your risk effectively. And that means taking small profits over and over and over again. Remember, a business, they'll sell products, they'll buy and sell, buy and sell, buy and sell, and they'll take gains consistently or profits. They're not just looking for one big smasher and to just dump the company. They want longevity. Okay, so trading too large just won't give you that longevity, because you're going to find there'll be times where big wins come with big risks. And if you have several big risks in a row that go wrong, you'll get closed out. So it's not consistent at all, and you want to stay solvent over time. Okay, and especially if those risks are unexpected, like your black swan events, you're going to find that you get closed out. So in short, just trade like a business, make profit over time. We don't want to rush. We want to make sure we understand leverage and understand position sizes in relation to our capital, so that our risk management is correct. So thanks for watching this, guys. All my risk management plans are in my course and available on my site. If you want to learn to trade like us, just click the link in the bio and it will take you straight there. I'll see you in the next video.